Welcome to The Explainer. Today, we're doing a full-on corporate health check on an absolute titan of the Indian financial sector, HDFC Bank. Following its historic, just massive merger with its parent company, HDFC Ltd, the entire landscape of Indian banking fundamentally shifted. But, what does the math actually say about the health of this newly formed behemoth? We're going to look under the hood using recent analyst reports and rating rationales to figure out the real financial story here.
So here's the defining question we're answering today. How exactly does a financial giant digest a multi-billion-dollar merger? Integrating the colossal balance sheet of a housing finance major into a traditional bank is literally no small feat. It comes with incredible strategic power, sure, but also some serious financial indigestion in the short term. We're going to separate the temporary symptoms from the long-term prognosis.
Okay, let's dive into this. Here is our roadmap for today. First, the mega merger aftermath. Then we'll hit liquidity, deposits versus loans. Next up, margins and profitability ratios, followed by asset quality and capital. Then we'll check out subsidiary strength and valuation. And finally, wrap it up with the future outlook and verdict. Starting right off with Section 1, the mega merger aftermath. To really understand the current numbers, we first have to look at the dual reality of this structural shock. On the one hand, we have the long-term gains. HDFC Bank is now the second largest bank in India by asset base, boasting expanded scale, a truly dominant retail reach, and massive systemic importance. But absorbing a housing finance company means taking on a completely different kind of liability structure, and that has created an immediate drag on net interest margins, or NIM, and pressured their cost ratios. It's basically a classic tale of short-term pain for long-term gain. Moving right along to Section 2, liquidity, looking at deposits versus loans. Checking the immediate vital signs, one number really jumps out. 14.4%. According to Modi Law Oswald data, HDFC Bank achieved a stellar 14.4% year-over-year growth in deposits. This acts as a really powerful remedy for the bank's expanded balance sheet. In an environment where the entire industry is fighting tooth and nail for deposits, HDFC Bank's unparalleled retail franchise is seriously flexing its muscles, gathering over half of the entire year's deposits in just the fourth quarter alone. And why does that 14.4% deposit growth actually matter so much? Well, because it directly impacts this metric right here, 94.6%. That's the credit deposit, or CD, ratio. Post-merger, this ratio was running extremely hot, peaking near 110% as the bank absorbed HDFC Limited's massive loan book. A high CD ratio basically means the bank is lending out almost all the deposits it takes in, which can strain liquidity. But thanks to that aggressive deposit mobilization and carefully calibrated loan growth, they've successfully cooled this ratio down to a much, much healthier 94.6%. But it's not just about the sheer amount of deposits. It's about the type. Let's quickly define the CASA ratio so we're all on the same page. It stands for current and savings accounts. It basically represents the proportion of a bank's total deposits that are sitting in these lower cost accounts. The higher the CASA ratio, the cheaper the bank's overall cost of funds, which directly boosts profitability and ultimately shareholder value. Looking at the historical trend, though, reveals the current challenge. In FY23, pre-merger, HDFC's CASA ratio was a very robust 44.4%. But post-merger in FY24, it dropped to 38.2%. And analysts actually project it to moderate further to around 34.1% by FY26. So why the drop? Mostly two reasons. First, they added a massive chunk of non-CASA term deposits from HDFC LT. And second, there's a broader macroeconomic shift right now, where customers are just moving their money out of savings accounts and into higher-yielding term deposits. Okay. On to Section 3, margins and profitability ratios. Let's see how they're actually making money. The absolute most critical metric here is the net interest margin, or NIM. Simply put, it's the difference between the interest income a bank earns from its loans and the interest it pays out for deposits and borrowings. Currently, HDFC Bank's NIM is hovering right around 3.3% to 3.4%. Now, it's under pressure precisely because of the merger. They're currently carrying a lot of higher-cost borrowings that they inherited from HDFC Limited. But as these mature and get replaced by those cheaper retail deposits we talked about, we expect this margin to gradually expand again. And this brilliantly illustrates the big picture. Despite those margin pressures, this DuPont's analysis projection captures the core profitability engine beautifully. Return on assets, or ROA, is a key benchmark of banking efficiency. Historically, HDFC Bank targets an ROA of over 1.7%. Well, even with all the merger integration costs and margin compression, the bank is still estimated to hit an ROA of 1.84% in FY27, scaling up to 1.91% in FY28. This basically proves their core operating machinery remains incredibly efficient, supported by cost-to-income ratios that are expected to stay tightly managed. Furthermore, the target return on equity, or ROE, remains highly robust. The bank traditionally targets an ROE well above 14%, and analysts actually forecast it to hit 14.4% in FY27 and 14.9% by FY28. So while the engine definitely took on a massive new load, its horsepower hasn't diminished one bit. Those profitability targets are still very much within reach. Shifting gears now to Section 4, asset quality and capital. Because look, high growth and strong margins mean absolutely nothing if your loans turn bad. But here, these numbers are quite literally the envy of the banking sector. Gross non-performing assets sit at a tiny 1.15%, and net non-performing assets are a microscopic 0.38%. This directly reflects HDFC Bank's famously tight underwriting standards. On top of that, their provision coverage ratio, which is the money they set aside for bad loans, is perfectly stable at roughly 67%. So they aren't taking reckless risks to fund their post-merger growth at all. Their asset quality is pristine. And then we have this figure, 17.23%. This is the bank's Common Equity Tier 1 or CET1 capital ratio. To put that into perspective, think of CET1 as a fortress-like shock absorber against economic potholes. The regulatory requirement is way, way lower, which means HDFC Bank is sitting on an absolute mountain of high-quality capital. This ensures they can easily fund medium-term growth and weather any unexpected macroeconomic storms without even breaking a sweat.
Let's look at the broader group now in Section 5, Subsidiary Strength and Valuation.
Moving beyond just the core lending business, this wider family creates massive cross-selling power. For example, HDB Financials, one of the group's key subsidiaries, is showing steady double-digit loan growth alongside a massive 42% year-over-year profit after tax growth. So the crucial point is that the broader HDFC group, which spans asset management, life insurance, and securities, adds immense fee income and cross-selling capabilities that really insulate the core banking revenues.
So how is the market pricing all of this? Let's check out the expected trajectory of the price-to-book or PB ratio. Now, the PB ratio simply compares a bank's market value to its accounting value. Currently estimated at 2.2 times for FY26, analysts project it to moderate to a really attractive 1.8 times by FY28 as the adjusted book value grows from 351 to 439 rupees per share. Historically, for a bank putting up these kinds of return ratios, this signals a very compelling valuation curve for market participants.
Finally, Section 6, Future Outlook and Verdict. Now, over the next 5 years, it's not going to be entirely smooth sailing. Macro headwinds are definitely present. A declining interest rate environment could put further pressure on those net interest margins we talked about. There's also industry-wide stress in unsecured retail lending right now that requires some careful monitoring. However, management has given very clear guidance. They are intentionally slowing down aggressive credit growth to bring that CD ratio down to about 92% by FY28. To balance everything out, their loan book mix is actively shifting, with highly secure corporate and SME lending stepping up to drive the growth forward. So, what is the street actually saying? According to the recent report from analysts at Motilal Oswal, the verdict is a reiterated buy rating. They've set a target price of INR 1,100, which suggests an approximately 38% upside from current market prices, basically highlighting this as a highly attractive level for long-term accumulation. Their rationale? It's heavily grounded in the bank's healthy business growth, the expectation of gradual NIM expansion once those high-cost borrowings retire, and of course that impeccably robust asset quality we just went over.
To summarize the diagnosis for you, yes, the patient is experiencing a bit of financial indigestion. The short-term drag on margins and the CASA ratio are just real mathematical realities of absorbing a massive housing finance balance sheet. But the core vital signs, the asset quality, the capital reserves, and the subsidiary growth are incredibly strong. The clear consensus from the rating agencies and analysts is that this merger structurally strengthens HDFC Bank's financial dominance for the long haul.
Thanks so much for joining me for this corporate health check. Keep an eye on the numbers and keep learning, because the execution over the next 2 years will be the ultimate test. Which leaves us with one final question to ponder. Are the short-term integration pains actually worth the long-term gains of India's biggest private banking behemoth?